hold on. All right, hello everyone. Welcome to this webinar, how to use your self-directed IRA to purchase real estate. My name is Seewing Yee from Yee Real Estate Network. I really appreciate all of you logging in to listen to this very, very important webinar. And I have a special guest. His name is Lamar Baxter. He's from Sacramento, and his company name is AccuPlan Benefit Services. And as you guys know, many of my investors, especially in the past 3 or 4 years, have been using their self-directed IRA to buy real estate, and I've been working with a lot of investors lately to help my investors to purchase. What an exciting opportunity! Very few people in the country are aware that you can use your self-directed IRA to buy real estate, and Lamar again will speak for the next 40 minutes or so all the features and benefit of using a powerful investment strategy. So without further ado, I'm going to introduce you Mr. Lamar Baxter. Are you there, Lamar?
I'm here.
Okay, take it
Hello,
away.
everyone. Thanks for introducing me, Seewing. It's a pleasure, actually, to give this information out. I think, as Seewing indicated, the majority of the population is not aware that a self-directed IRA exists, or even what it is. And that would include some of your professionals, whether it be your legal professionals or tax professionals. So my objective today is to give you a brief overview in terms of what is a self-directed IRA and its many uses. Just to kind of give you a background of myself, I have over 22 years of varied financial experience, including, I would say, good 13 plus years in mortgage, both residential and commercial. I'm also an investor. Currently, I'm using my self-directed SEP IRA to invest in trust deeds, as well as give out private loans secured by first deeds of trust against real property. Before I get started, I want to kind of give our disclaimer, because our objective, once again, is to provide education to kind of give you an idea how this tool can be used to grow your retirement funds. So before we get started, just kind of run over our disclaimer. AccuPlan Benefit Services, we do not provide any investment advice as well as any legal or tax advice. It's very important that you consult with your tax and legal professional regarding any investments that you may be considering using this product. As with any investment, there are the potential for loss, and the main objective is to perform your due diligence on the investment as well as any investment offerings that may be presented to you. So before we get started, like I say, I'm just going to give you a kind of a quick overview in terms of who is AccuPlan, what is our role, and what is our responsibility as an administrator as well as a custodian. AccuPlan Benefit Services, we provide self-directed and retirement services for both IRA as well as 401ks. What that means is that if you have an existing IRA or an existing 401k where you've actually terminated employment and you have full access to those 401k funds or any other employer-sponsored funds, you have the ability to transfer or roll over those funds to a self-directed plan. All of the rules are pretty much the same as it relates to IRS code in terms of what your contribution limits are and so on and so forth. So whatever you may have, for example, as it relates to a 401k or an IRA, whatever your contribution limits would be for that particular plan would be the same with a self-directed plan. All of our plans are actually self-directed, so the most common question is, well, which plans are self-directed? And when you look at the list of plans that we offer, and I'll show that slide to you guys in the latter part of the presentation in terms of what plans can be self-directed. We pride ourselves on the expertise of low cost and quick service for self-directed IRAs. We maintain a very experienced staff in both tax and legal backgrounds in terms of IRA and 401k setups. Before we get moving into I would say, the breadth of the conversation in terms of the presentation, just want to share some statistics with you, and the most common reason why most individuals as well as retirees are considering the self-directed plan. For starters, volatile world markets and looming tax increases. As we've been watching in the news or reading in the newspaper, there's a lot of volatility in our economy, both domestically and abroad, and that's usually going to result in some tax increases. We've experienced some in tax increases both at the state and federal level as of January 1st of this year. It is estimated that 10,000 baby boomers per day will turn 65 for the next 19 years. And of that segment of the population, 75 to 90% of the boomers do not have the resources to retire beyond the age of 65. Some may feel that if it's an option that they will continue working beyond the age of 65, but I've actually had some clients who've been aware or it's been brought to their attention that because of the occupation and the nature of their occupation that they may not have the option to work beyond the age of 65. So it's really important that you take a proactive approach in terms of where you are presently as well as where you may be in the future as it relates to your retirement fund and your tax situation. Most will be forced to work beyond the age of 65, as I mentioned earlier, once again, as if the employment will allow it. Retirees will face skyrocketing health care costs and diminished Social Security benefits. So a lot of benefits that we've received, or should I say our parents and grandparents have received in the past, may not be present for us when the time comes for us to retire. We also got to factor in inflation and cost of living increases that will erode the fixed retirement income that we may have in place. So not to mention that what you may have lost, say, back in 2008 as it relates to the total amount you have in your retirement nest egg, but you also have to factor in inflation and cost of living that will continue to erode that fixed income that you may have coming in. So it's important to, once again, look outside of just your traditional investments and look at also what we call the alternative investment options and make sure you're basically making the best retirement decision that you can to grow your retirement account that will sustain you through your retirement years. Over $4.7 trillion in combined IRA funds and 401k funds are out there, and they say 1 to 2% of that total $4.7 trillion is invested in alternative investments or self-directed plans. That is a very meager number as relates to $4.7 trillion, only 1 to 2% are in alternative investments. So we definitely, as retirees or potential retirees, we need to increase that number from that 1 to 2% and hopefully get it up to at least the double digits to kind of give ourselves a chance to be able to sustain through retirement years. So we'll go to the next slide here. Lack of investment diversification, that's something that we also want to advocate to, whether it be the current investor or the potential investor. Some may feel that they have maybe 5 or 10 different investment pools within their existing portfolio. But when we say lack of investment diversification, are all of your eggs in one basket, so to speak, are all of your funds and traditional investments. You definitely want to explore outside of the traditional investment realm and also look at your alternative investment classes. It's estimated that $5.3 trillion were held in IRA and 401k funds at the end of 2012. So I mentioned earlier it was 4.7, and usually they'll keep track in terms of what that number is at the end of the year. So it has definitely been an increase from 4.7 to 5.3 trillion by the end of 2012. As I mentioned earlier, the majority of those funds are invested in your traditional investment, whether it be mutual funds, CDs, stocks, bonds, annuities, so on and so forth. As I mentioned, there's nothing wrong with those investments, but the objective is to make sure that you're getting the biggest bang for your buck and that you're getting the highest return on every investment dollar that you have out there. Less than 2% is invested in alternative investment assets, as I mentioned before, so definitely we need to change that. It is said that 90% of the population is unaware of a self-directed IRA, and you wouldn't believe that of that 90%, that would include attorneys and other professionals, some of your current financial planners and advisors, and the reason a lot of times they're not abreast of these types of plans because based on a plan agreement is usually what's going to determine what a custodian will allow you to invest your investment dollars, or should I say your retirement dollars. And so, for example, looking at a Charles Schwab or a Franklin Templeton, as some of your more common traditional custodians, usually the options you have is stocks, bonds, annuities, CDs, and if you're looking to invest in real estate, maybe they'll allow you to invest in a REIT. But a lot of times they will not allow you to invest in any hard assets such as real estate. Looking at, once I mentioned here, 90% of the population, that also includes some of your tax professionals, including CPAs. I actually have given some presentations, some educational webinars to some of your tax professionals because they also need to get up to speed on this. Keep in mind, as like with a doctor, you have a doctor who may be a brain surgeon versus a foot surgeon. Same would be applicable to a tax attorney or as well as a CPA or any other tax professional. Some only specialize in certain areas of the tax code. So they also are trying to come up to speed in terms of how this plan works and how this investment vehicle can be basically passed along to some of their clients and get that information out to their clients. Your current custodian may not offer a truly self-directed IRA. So what does that mean? A self-directed plan, should I say the term is a kind of a generic term. Their definition of a self-directed plan, meaning that they may offer you 10 or 15 investment options, and because they offer you those 10 or 15 investment options, they are in a position to say that they offer a quote-unquote self-directed plan. A truly self-directed plan will allow you to invest in everything with the exception of life insurance and collectibles. So once again, the exception up to the rule in terms of which you are restricted to invest in, and we'll cover that in some future slides, would be life insurance and collectibles with a truly self-directed IRA. So our motto in the self-directed IRA industry is invest in what you know and understand. I like to believe that the general population has some kind of background or expertise in some particular area of investment that they have a lot more knowledge of than maybe their financial planner or advisor may have relative to the stocks or some of the investment options that they're recommending to their clients. So what we're looking at is the client or the investor or retirement account holder who is pretty much fed up with the returns that they're getting in the traditional accounts and want to look outside of the box, so to speak, and look at alternative investments. The four categories here on your screen are some of the more common transactions that I see come across my desk, or at least have come across my desk over the last 5 years that I've been in this industry. Real estate is, I would say, the number one asset class where most of our clients are using their self-directed IRA or 401k to make their investments. Real estate would consist of single-family residence, commercial, land, as well as REITs. Once again, with the self-directed retirement plan, you have the option to invest directly in the property, not into a REIT, but if you choose to do so, that is an option. Precious metals was pretty popular, I would say, up until 2010, is beginning to pick up speed again, or should I say steam again, as the devaluation of the dollar blooms. So, of course, a lot of times most people look at the precious metal or any other hard asset as when they want to basically pull the money out of the market and put it in something tangible, such as real estate or precious metals. Private notes and loans, that is an option. Whether it be secured or unsecured, you have the option to become a bank, so to speak. As I mentioned earlier, I actually have a self-directed SEP IRA where I actually loan money from my SEP IRA that is also self-directed and secure my investment by a first deed of trust. I charge anywhere from 12 to 14%. With the maximum loan to value not to exceed 65%, and I usually see a turnaround on my money every 6 to 9 months. So, you have the ability to pretty much set the terms as you see fit in terms of what you're looking for as far as a return on your dollars, but private notes and loans is an option that's available to you. Private companies. There's a lot of cash-starved existing organizations out there, as well as these startup companies that are looking for private capital. So that is another option that you may want to explore if you're looking to perform the necessary due diligence on that company, whether it's an existing or startup company. You can actually invest in that company, and there's a variation of structures that you can use to make that investment in those private companies. But you definitely want to consult with a knowledgeable professional, whether it be an attorney and or a tax professional, before you move forward on that type of investment, because it involves a lot more steps than some of your other transactions, but it's something that a lot of our clients are taking advantage of as well. So as I just mentioned on the previous slide, the four common transactions I see come across my desk, these are some of the more popular options that are nationwide, and this is not by no means the entire list. This is just some of the transactions that a lot of clients are using their self-directed plans to make investments. I'm sure if you were to look at this list of options that's available and you were to contact your existing plan administrator, or should I say your existing planner or advisor, and ask them, can you use your existing plan to invest in any of these options, the answer would be no. The objective here is to look at this list here and say, wow, I did not have an idea that this was available to me using a self-directed IRA or 401k. The objective here, once again, is to get you to think outside of the box that you were painted into over the years to limit you in terms of what you can use your retirement funds to grow your retirement portfolio. Prohibited transaction, and this is really a good subject because it's ironic that I had a client that I'm still working on today, where they committed a prohibited transaction because of faulty information that they received from their real estate agent. So this is something that we need to basically pay close attention to, and I'm going to make reference to that transaction to kind of give you an idea of what not to do to avoid this pitfall, so to speak. Prohibited transaction basically involves non-authorized transaction in accordance to IRS Code 4975. As I mentioned earlier, the limitations or restrictions in terms of what you can and cannot invest in is life insurance and collectibles. These four subcategories would represent an example of what collectibles or anything that you would basically deem as tangible and you would personally more likely take personal possession of. You cannot take personal possession of any IRA-owned asset. It must be held by either a custodian or a third-party depository or holding company as it relates to any asset held by the IRA. So just keep in mind, if you are even remotely thinking that you want to make an investment in something tangible and you're thinking of holding it personally in your name directly or indirectly, it is considered a prohibited transaction. So here's an example here just of what we consider a prohibited transaction, what some of these assets would look like in terms of prohibited assets that you are allowed to invest in. That would be any work of art, any rug or antique, metal or gem, stamp or coin collection, any alcoholic beverage. So when we say alcoholic beverage, it's not limited to just any alcoholic beverage. When we say alcoholic beverage, a lot of investors or clients are looking to maybe invest in a wine collection. I mean, it's okay to own a winery, but you cannot actually own a wine collection. So one would say, well, why a winery and not the wine collection? Usually when you're investing in a winery, you're usually investing in the actual real estate or the actual business, which is a permissible transaction. In the case of investing in a wine collection, that is something more likely that you will be holding or taking possession of. It's not likely that you're going to have a third party commercial party that would actually hold your wine collection. And if you are able to find someone to do that, that may be a business niche in the future, then it would be considered a permissible transaction. But the main objective is to make sure that no asset is actually held by you or any other disqualified person. And we're going to talk about other disqualified persons other than the account holder in the next slide. Okay, so once again, IRS Code 4975 is the Internal Revenue Code section that you want to refer to. If you're not sure in terms of what you're reading, you definitely want to pass that information along to either your tax attorney or your tax professional to have them consult with you and explain how this rule works and how it may apply to your particular transaction. Once again, we're not allowed to give any form of advice, but we can if you were to give us a call and ask us based on a potential investment transaction scenario as to whether that transaction is compliant or not. We can pretty much tell you yes or no, but you definitely also want to consult with your tax professional because you can basically give me a scenario that may apply to maybe 3 other potential investors based on their tax scenario or a particular scenario, but it could vary from transaction to transaction, so you definitely want to make sure you provide all the details and to make sure that you're not providing or committing a prohibited transaction directly or indirectly. Some examples of prohibited transactions between a disqualified person and an IRA would be, for example, selling and exchanging or leasing property. If you're lending money, as I mentioned, you can lend money to any person who's not a disqualified party. And I'll mention once again in terms of, I'll give you that list of disqualified parties in the next slide. Furnishing goods and services for facilities. What does that mean? You may have an existing business, and because that business, you may have a controlling interest, say 50% more stake in that business, you cannot use your IRA funds to, say, for example, loan money to that business or purchase a business and actually do business with the existing organization where you have a controlling interest or stake in that business. So keep in mind, whether it's a direct or indirect rule transaction, IRS Code 4975 relative to prohibited transactions would apply. And most would ask, well, how would the IRS know whether I'm committing a prohibited transaction? They usually will not know, but the unfortunate part is if there was ever an audit, they will go through your entire retirement account, look at all incoming and outgoing transactions and all the supporting documentation to determine whether, one, any prohibited transactions occurred as it relates to using personal funds with IRA funds, as well as making sure that you have not done any business directly or indirectly with any disqualified person. So the main objective is to run a clean IRA or 401k and follow the rules. So as we mentioned in the previous slide, we talked about prohibited transaction, which also ties into a disqualified person. Who's a disqualified person? So here's some examples of disqualified persons or disqualified parties. Starting off with yourself and your spouse. You and your spouse are prohibited from doing any business with or your IRA, or whether it be directly or indirectly. That also include parent, grandparent, children or grandchildren, And that would also include spouses, as I mentioned earlier, spouses, and it's including their parent, grandparent, children, or grandchildren. So the question will come up is that, well, I understand I can't do business with my spouse, but what about my spouse who has children from her previous marriage? As they mentioned, the direct and indirect rule, that would also apply to your spouse and even her children or grandchildren or parents or grandparents from, say, another relationship, or even their parents and grandparents are prohibited or disqualified parties. Any fiduciary of the IRA. So, for example, a real estate agent is representing the client or the IRA in a real estate transaction. They are allowed to represent, even though they have a fiduciary capacity, they are able to represent that IRA in terms of acquiring or selling that property. However, that IRA, or should I say that real estate agent or broker, is disallowed from partnering with that IRA or the account holder by way of investing their funds in conjunction with the IRA funds because of that fiduciary relationship. Once again, that broker or agent is allowed to conduct the transaction and receive a commission, but they're prohibited from using their funds, whether it be IRA funds or personal funds, in this joint transaction. Anyone providing services to your IRA. That would also include me. I get this a lot after I do a presentation, whether it be live or via a webinar, because I loan money out of my IRA. AccuPlan provides services to your IRA, and because I personally am your rep, I would be prohibited from doing business with you. So if the next question would come up, well, what if I go with another custodian? As long as I or AccuPlan is not representing your IRA or 401k in the transaction, then it would be a permissible transaction. But if you're holding your funds within American Estate and Trust or AccuPlan, then it would be deemed as a prohibited transaction. Corporation, partnerships, trusts, and other entities. That question comes up a lot as well. I have an existing business, be a corporation, partnership, LLC. I own, say 50% or 51% in that entity. Am I able to conduct business, loan money, and so on and so forth? The answer is no. Keep in mind, the rule is if you and your spouse combined have more than a 50% controlling interest in that organization, it's considered a prohibited transaction. So just keep in mind, if you have an existing business and you want to do business, make sure that your ownership as well as your spouse's ownership combined, percentage of ownership combined, does not exceed 50%. Okay, so we're going to go on to the next slide here. It's going to make sure that you're retaining this information here. And this is something that I usually will kind of use in my live presentations to make it more interactive. But I'm going to read off some questions here, and this is really important that you understand because this ties into prohibited transactions and disqualified persons. So the first question is, your IRA lends you personally $10,000. Is that a permissible transaction? And because we mentioned earlier in terms of who disqualified persons are, you personally as well as a spouse is a disqualified person, the answer to that question would be no deal. The next one would be your IRA lends your brother $10,000. Okay, is that transaction permissible or permissible? Is it permissible or non-permissible? As I mentioned on the previous slide, I gave you an example of who the disqualified parties were. Remember, the list of items, or I should say the list of disqualified parties as it relates to relatives related to those who are in the vertical line of the relationship line. Anyone who's on the horizontal line of the relationship chain, such as brothers, sisters, aunts, uncles, so on and so forth, are considered permissible parties. So in that case, this is a deal. This is something that is a permissible transaction. So you can lend money to your brother, aunt, uncle, sister, or any other siblings that are not on that vertical line of relationship. The next question is, your IRA lends your former spouse $10,000. Is that a deal or no deal? Well, the answer to that is this is a deal, because keep in mind, you are no longer married to your former spouse, so that is a permissible transaction. The next question, your IRA lends your daughter-in-law $10,000. Is that a deal or no deal? Keep in mind, as I mentioned about the direct and indirect rule, those who are on the vertical line of relationship, whether it be ascending or descending, is considered a disqualified person, and it also includes any in-laws, such as the daughter-in-law and so on and so forth. So this would also be considered a non-permissible transaction, so that would also be a no deal. So the main objective here, or should I say the main message here, is do not mess with the IRS. And what I want to do is share a real quick case study, or should I say an example of which I'm actually still trying to untie this, or at least assist the customer in untying this mess as it relates to a prohibited transaction. It's important that once you go into, when you open up your escrow, that you open up the escrow under the name of the IRA. So, for example, it would be American Estate and Trust, FBO, your name, and then your account number. You're not allowed to open up escrow under your name personally and then transfer that contract from your name personally over to the IRA. Once our compliance department or any custodian's compliance department sees any reference where you or any other disqualified person took part in securing that contract and attempting to transfer to the IRA, it's a prohibited transaction. So the question in this particular scenario was, the customer actually he was able to remedy the contract situation because he destroyed the former contract in time and rewrote the contract. However, he used personal funds to secure the property in the form of an escrow deposit. Keep in mind, the title company or escrow company is required, based on their auditing requirements for its record keeping, to keep track of every cent that goes in and out of that escrow account relative to that escrow number. So what happens is, at the end of the close of escrow, when we look at the HUD-1, it's definitely going to show that personal funds was shown at one point in time have been used within that escrow. Even though the funds were refunded to the customer, it basically shows on that escrow deposit, or should I say on that estimated closing statement or HUD-1, that at some point in time throughout that transaction that personal funds were used, which is deemed as a prohibited transaction. The remedy, hopefully, and this is definitely a remedy provided that the selling agent or the bank is going to allow enough time to remedy the problem, but the remedy here is to close out the existing escrow account, reopen a new escrow account, transfer the funds from the IRA, from the old escrow account, back to the IRA, and then for the IRA to disperse those funds back into the new escrow account. This is the only way that the title company can meet its objective by not showing the personal funds on the HUD-1, and at the same time, when that HUD-1 goes to our compliance department, does not reference that the personal funds were used. Now, we'll see what happens as it relates to this transaction as to whether the selling agent or the bank is going to allow them the additional time to remedy this problem, but this could be a nightmare and can cost you either loss of an escrow deposit, or if the transaction was to go through, taxation at normal tax rates of the full IRA, not the transaction amount, but also a 10% early distribution penalty if you're under the age of 65. So keep in mind, or I should say under the age of 59 and a half. So keep in mind, you definitely want to make sure that before you go into contract, that you at least establish your IRA account. Make sure you have funds to satisfy the escrow deposit using only IRA funds, not personal funds. So I just want to share that with you because, once again, anytime something comes up like that, I usually like to give live scenarios in terms of why rules must be followed and how they're usually caught and hopefully sometime can be remedied. So the next slide here, we're going to talk about how do you fund your IRA or 401k. So how do we get funds into the account? So we're going to start with the first option, which is a transfer. A transfer involves transferring funds from one IRA to another IRA. The funds usually do not or never actually takes place in terms of the funds going directly to the account holder. The funds are transferred, for example, from Charles Schwab over to AccuPlan, and there's no taxable event. The process usually takes anywhere from 7 to 10 business days from the date that the receiving custodian receives a written request authorizing those funds to be transferred. The funds can be transferred via wire or check, whichever option you check off on the transfer request that's required to be sent over in writing to requesting those funds. A rollover is the method of moving funds from either an IRA or 401k, more commonly used in terms of moving funds from a 401k or any other employer-sponsored plan where the plan allows those funds to be moved either during service or after service. So what do I mean by during service and after service? In most cases, you're prohibited from moving a 401k or any other employer-sponsored funds unless you've terminated employment, no longer working with the company, or you at the mature age of retirement, either 59 and a half or 65, however, whatever is applicable as it relates to your plan agreement. Once you've met those milestones, you're able to roll over those funds. Rollover can be done directly or indirectly. Directly would mean that you would contact your existing custodian, provide them the name and account number of your new self-directed plan. They will then complete paperwork internally, using their paperwork, they would then either wire or cut a check payable directly to you or to the name of the self-directed plan. You then have within 60 days of that check being cut or wires being sent, well, in most cases it's a check, you have 60 days to get those funds over to the new plan without a taxable event or any penalty. Usually that process can happen within a 3 to 5 day business period of time. In most cases, if someone is under certain time restraints, they may opt for a rollover with an IRA versus a transfer because, once again, it sometimes can occur a little faster than a 7 to 10 business day period of time of a transfer. Your contribution, that's where you're actually going to be pulling funds out of your pocket and actually making a contribution, whether it be for 2012, 2013, or that applicable tax year to the applicable plan. Your contribution limits are going to be relative to what type of plan that you're eligible for or open up to that full amount, provided that you've met all the other requirements such as not exceeding certain modified adjusted gross income limits. So definitely before you open up an account, you definitely want to consult with your tax professional as to which is the best plan for you, both for the highest contribution limit as well as what you qualify based on your modified adjusted gross income. Because on the next slide, we're going to talk about contribution limits. Those limits are up to, they're not guaranteed limits that you have access to, because sometimes modified adjusted gross income limits may reduce you down to the amount less than the maximum amount allowed to contribute to that plan. A conversion, something that's real popular, it has been popular since 2010, and it's real popular in 2012, and I'm sure it'll be popular in 2013. This is a method of converting or moving funds from a tax-deferred account such as a 401k, SEP IRA, a simple IRA, or a traditional IRA where you've deferred paying taxes until you turn 59 and a half or 70 and a half. In this case here, you're going to pay taxes on either the full amount or the partial amount that you're going to convert from that tax-deferred account over to the Roth account. The nice thing is, like I said, you pay taxes on whatever the current rate of tax bracket you're in currently, opposed to whatever the tax rates may be at 59 and a half or 70 and a half. After 5 years and 59 and a half, if you met those two milestones with the Roth IRA, you don't pay any taxes, or should I say any federal income taxes, on any growth that you realize in that account. So, for example, you purchase a piece of real estate for $100,000 in 2013. Say in 2017 or 2018, that property has tripled in value. As long as you've converted that IRA or those funds from that IRA over to a Roth IRA, you can really care less what the tax rates are going to be at a federal level, because you've already met your obligation in terms of paying taxes once you converted those funds to the Roth at its inception, or should I say at the basis of the $100,000 purchase price of that property. So when that property is now $300,000 and you either decide to move into it or you decide to sell it at a later date and time, you don't pay any federal income taxes. As you note, I mentioned federal income taxes. Depending on which state you live in, you may be subject to the state taxes that are applicable for that particular state. So, but that is something you definitely want to consult with your tax professional on, as well as to what your tax situation may be at retirement, because you may be in California now but move to Nevada where there is no income taxes in that state, and that's something that is that's allowable as well. That way you avoid paying any taxes at the federal or state level if you have a Roth IRA. So as I mentioned here in the previous slide, we're going to talk about the different types of plans that are self-directed. These are all the types of plans that you may have seen with your existing custodian. All the rules are applicable to the IRS code, so there's nothing different between what we offer through our self-directed plans other than opposed to what, say, a Charles Schwab or Franklin Templeton offers. The only difference between our plan as well in conjunction, or in comparison to the other custodians, is that our plan agreement allows you to make both alternative investments as well as traditional investments. So you really have the best of both worlds. So here are the contribution limits for our self-directed plans, or any self-directed plan involving these account types. So these are the 2012 contribution limits. These limits will be applicable up through April 15th of 2013. Traditional IRAs, as I mentioned, as a tax-deferred account, you can contribute up to $5,000 per up through April 15th of 2013. And if you're over the age of 50 and a half, you can contribute an additional $1,000. The Roth IRA, same contribution limits, same rules apply. If you are over the age of 50 and a half, you can contribute an additional $1,000 to that $5,000 for through the tax year for the tax year of 2012 through April 15th of 2013. The SEP IRA, $50,000, is also a tax-deferred account. You can contribute up to $50,000. Now, here's the caveat with the SEP IRA. You have restrictions. The rule is that you contribute up to $50,000 or 25% of your modified adjusted gross income. So, for example, if you have a $200,000 and that's what your modified adjusted gross income would be, you can contribute 25% of that $200,000, which is the $50,000. You cannot exceed the $50,000. There is no catch-up limit on the SEP IRA. Prior to 2010 there was, but they actually eliminated that catch-up on the SEP IRA. Once again, it is a tax-deferred account, an account that is commonly used for those who are 1099 and self-employed. If you're a W-2, you're not allowed to contribute to a SEP IRA. I know I have some clients who were formerly self-employed or 1099 where they have a SEP IRA, but they can no longer contribute to it, but they can always transfer or rollover funds from another retirement plan into that SEP IRA. In most cases, if you're W-2 or 1099, your restrictions are going to, or should I say the plan options that you're going to be limited to would be a traditional IRA and a Roth IRA. The Simple IRA is another employer-sponsored plan. It's pretty common amongst those small or medium-sized businesses with less than 100 employees, where the contribution limit is up to $11,500, a $2,500 catch-up if you're over the age of 50 and a half. This is also applicable to those who are, once again, self-employed or 1099 or have a small business or medium-sized business with less than 100 employees. 1K or solo K. This here is what we consider a hybrid between a SEP IRA and a 401k. So with the 1K or solo K, you're able as a 1099 or self-employed individual or business contribute up to $50,000 for the tax year of 2012 with a $5,000 catch-up. So $5,500 could be the maximum contribution you can actually make to the 1K for the tax year of 2012. And how this works is you can contribute as both an employer as well as the employee. As the employer, you can contribute up to, let's say, that 25% of your modified adjusted gross income, and then the balance you can contribute $16,500 as an employee. So once again, $16,500 as an employee for the tax year of 2012, and the balance could be made up based on the modified adjusted gross income, the balance. So just keep in mind, these are some of your plans that's available to you. You definitely want to sit down with your tax professional before opening an account to make sure that whichever account that you choose is going to be the best for you, both short-term and long-term.
Lamar, may I say something?
Sure.
Yeah, most of my investors, they are pretty much W-2 employees. They are engineers or computer programmers or people work for corporations. So they are somewhat limited in their annual contribution. But however, from time to time, I would say 10% of my members of my network, they are self-employed, and in fact, I'm working with several of my self-employed clients where they have to make a lot of money. 25% of the modified adjusted gross income, we're talking like $200,000 net profit after deductions. Okay, and a lot of self-employed over the years, they take too much deductions that will reduce their modified adjusted gross income, whereby they cannot maximize the annual maximum contribution on the SEP and the solo 401k. But but again, in fact, I'm working with a couple of one dentist, a client of mine, and one physician, where they are making a huge amount of money, and they are self-employed. They have a Schedule C, or they have a partnership or LLC, and they are authorized to because they have a net profit more than $200,000 after deduction. So these are very high income individuals, self-employed individuals, that is. And isn't it amazing the IRS allowed them to contribute on an annual basis 25% of the AGI, which is
well, this is what most my high net worth individuals will do is, and for those, especially those who are self-employed, is they will take advantage, for example, of a 1K or solo K. They will open up the account as just the investment vehicle and not making any contributions to that plan. But they will, for example, there are some higher contribution plans that are not self-directed, and most of my high net worth self-employed individuals will take advantage, such as your defined contribution, defined benefit plans, where they have much, much higher contribution limits. So what they'll do is continue making contribution limits to those higher contribution plans, and then they will either transfer or roll over an unlimited amount to, for example, any one of these plans here. So this way here, say using the solo 401k, you have up to, for example, 2012, $50,000, but you have much higher contribution limits with some other plans that are not self-directed, but you just make your contribution to those plans and do a transfer or rollover over to your self-directed plan is how you achieve, get over that milestone.
Amazing opportunity, Lamar.
Yes.
Go on. Love this. Go ahead.
Okay, so as we're going to the next slide here, I mentioned what the 2012 contribution limits will look like. Same plans, however, you notice that the limits have increased for 2013. So please make a note. Once again, the rules will still apply in terms of modified adjusted gross income, so you definitely want to consult with your tax professional to see what your contribution limit should be for 2012 as well as for 2013, even with the new contribution limit. So we're going to go ahead and move on to the next slide here. We're going to talk about Roth conversions, whether it be partial or full. As I mentioned in a previous slide, one of the options in a conversion is moving funds from a tax-deferred account to a Roth account. That can be done either in a full conversion or a partial conversion. A lot have been led to believe, or they were deterred from doing a conversion because they were under the impression that if they were to convert, they would have to convert the full amount. That is not true. You have the ability to convert a portion, whatever you deem as the amount that you are willing to pay taxes on for that tax year, over to a Roth account. I actually have a client that comes into my office every 3 to 4 months and do partial conversions. His objective is to make sure that he's getting as much, if not all, of his funds from that tax-deferred account over to his Roth account over a certain period of time, but at the same time does not diminish his ability to have enough capital to continue buying and flipping properties. So you definitely want to kind of look at everything across the board, whether it be your tax scenario, as well as making sure you have enough investment capital to continue making the investments without basically putting all your money out to Uncle Sam in terms of taxes. So this is what an example of what a conversion would be, whether it be full or partial, what types of plans where you can actually make those conversions from. And as I mentioned earlier, the Roth, the milestones you must reach in terms of to receive tax-free growth in that Roth is that you had to have had the Roth account for at least 5 years, whether it's funded or not, and you are at least 59 and a half. After you've met those two milestones, any growth you realize in that plan, that Roth plan, you pay no federal income taxes on that growth. Okay, so we're going to go ahead and we talked about the conversions, so we're going to go ahead and move on to the next slide here. We're going to share a case study in terms of just how this plan can be used in a real estate transaction. And this case study here is going to be relative to someone buying and holding the property and then later selling it, but just want to walk you through the steps in terms of how the process works and what's involved. And this is really important that if you are someone looking to open an account to invest in real estate, you want to basically share this information with others who are looking to partner with you as well as your real estate professional, because this information here and steps they must follow as well. So in this case study here, we're going to use John. John is going to purchase a rental condo for $100,000 using his tax-deferred SEP IRA. He's going to transfer $125,000 from his existing brokerage account, say it's Charles Schwab, over to his AccuPlan self-directed SEP IRA. Keep in mind that he's going to keep his plan type the same. He has a SEP IRA, for example, with Schwab. So to keep things real simple, because he knows that he's qualified for that type of plan, he's going to transfer from his Charles Schwab SEP plan over to his AccuPlan SEP plan, which will be self-directed. So he's going to go ahead and purchase that property. He's going to initiate a purchase contract with his real estate agent under the vesting of his self-directed SEP IRA. And this is what the legal vesting would look like. It's going to be American Estate and Trust for the benefit of the account holder's name and then the IRA number. If you were to pull the property profile on this property after it closes, this will be the vested owner, legal vested owner of the property, not you personally, but this will be the legal vested owner unless you were go through an LLC structure. But this is who is going to be the reflected owner of that property. John's going to complete what's called an investment of direction form, which is one of our internal forms giving us authorization to act on the behalf of his IRA to conduct this transaction. As part of those instructions that's going to be included in that investment direction letter, he's going to instruct us to go ahead and send over an escrow deposit of $5,000 to the title company who's going to coordinate the closing. John is going to read the purchase contract. He's going to approve. We're not going to approve anything on the behalf of the IRA holder. It still would be your responsibility as the IRA holder to approve all conditions within the contract. However, we will be signing all closing documents for the transaction, whether it be to acquire the property or to sell the property at a later date. AccuPlan then wires over the funds to the title company to close. The warranty deed is then recorded and sent back to us for safekeeping until that property is later sold or refinanced at a later date. The SEP buyer is now the owner of the property, as I mentioned earlier. So if you used to pull a property search on that property, the vested owner would reflect American Estate and Trust for the benefit of the account holder's name and then their IRA number. It's going to reflect the address of the custodian, which would be American Estate and Trust, which is our parent company, as the custodian, and the Las Vegas address. John decides to, once again, this is going to be a buy and hold, so he's going to go ahead and hire a property manager. And keep in mind, the question comes up is, can I serve as my own property manager? And the answer is no. The IRS deem you providing any direct service or indirect service to the asset held by the IRA as a prohibited transaction. They look at any type of efforts such as property management, maintaining the property, rehabbing the property as sweat equity, and if it's ever discovered, it will be determined to be a prohibited transaction. So John locates a property management company to oversee the unit. The property management company finds a tenant for the unit. Rents and expenses are handled by the property manager, and you have different structures in terms of how you want either the gross rents to come back over to your plan and then a check cut back to the rental property manager to cover his or her fees, or you can basically have the fees deducted for any expenses and rental property management fees and send over the net proceeds to the IRA. However, keep in mind, whoever you hire as a property manager must keep detailed records of every expense that's basically taken out of those rent proceeds, and when he sends over that net check, that detailed expense sheet should be accompanied with the funds or the net check that is forwarded over to the IRA. Because keep in mind, in the event of an audit, every dime for income and expenses has to be accounted for. In this case here, the condo has a positive cash flow of $450, which is tax deferred because, keep in mind, John has a tax deferred SEP IRA. John has the ability to track his account online in addition to whatever records and documents that his his property manager provides him. So he's going to hold on to the property for 2 years. So 2 years later, he decides, okay, we're at the peak of the market. It's time to sell. So he's going to go ahead and sell the property to his existing tenant. He's going to sell the property for $150,000. A sales contract is going to be prepared for the $150,000. AccuPlan is going to coordinate the closing as we did in terms of the acquisition of the property. Also going to coordinate the closing with the title company for the sale of the property as well. On the day of closing, John is going to read and approve the purchase contract, get that over to us. We're actually going to sign and send the closing documents back to the title company. All proceeds from all net proceeds from the sale of that property will go back into John's self-directed SEP IRA. Remember, because it's self-directed and tax deferred, he pays no taxes. So once again, there's nothing he has to report on his tax returns, his personal tax returns, because there was no taxes to be paid because the plan is a tax deferred account. So we're going to go to the next slide, just kind of give you a breakdown in terms of what it looked like, a summary of what this transaction looked from acquisition to close, and what type of profit that was actually made on this transaction. So this is a summary in terms of what happened with this transaction. He acquired the property for $100,000. Over a two-year period, he actually received a net cash flow, or a cash flow of $10,800, which is the gross amount. We didn't factor in any expenses, but he received $10,800 in cash flow over a 24-month period. The gains from the sale, because remember, he paid $100,000 for the property, but he sold it for $50,000, so there was a gain of $50,000 in addition to the $10,800. So the total amount that he has in his IRA from this transaction, the gross amount would be $160,800. So looking at the gross amount, he actually made a gain of 61% over a 24-month period of time. And I'm almost certain if you was to look at, most of you, if you were to look at your retirement portfolio, whether it be a 401k or an IRA, no one transaction is going to net you those types of returns. So it's really important to really look outside the box, so to speak, and look at some of the better earning asset classes that can grow your retirement account. So here's a visual to give you an idea what the process would be to establish the account, fund the transaction, and transfer the assets over to us as the custodian until the asset's sold. The steps is pretty, it takes anywhere from, depending on whether you fill out the application online or do it manually. Most customers complete the application online, usually complete and get the account set up within, like, say, 35 minutes. Provided we receive the ID, within the same business day, we can actually give you your account number investing for you to enter into contract immediately. As I mentioned earlier in the presentation, it is very important before you go into any transaction, especially real estate, that you open your account, obtain your legal account number investing to enter under contract, because you're prohibited from entering into contract under your name and transferring that contract from your name to the IRA or 401k, as well as transferring or using any personal funds to secure to pay the escrow deposit, even if it's going to be reimbursed prior to the close of escrow, because once again, any funds received in that escrow account must be accounted for and must reflect even on the final closing statement. So we definitely do not want to see that. So you definitely want to make sure only IRA funds are used for your IRA transaction. Now, if you have a situation to where you're partnering with your IRA or partnering with someone else's personal funds, those are the only funds that are going to be used, personal funds that can be used. But keep in mind, if it's an all IRA purchase, it has to be in all IRA funds used for escrow deposit acquisition and the maintaining of that asset. So keep in mind, no commingling of personal funds. So that pretty much is my presentation. In summary, IRAs can hold all types of investments, not just securities. So once again, alternative. Keep in mind, to grow your retirement account effectively, you want to look at both alternative as well as traditional investments. There's nothing wrong with traditional investments. You just don't want all your eggs in one basket. Partnerships and split ownerships are allowed. I did mention that briefly, but that's pretty much another presentation in terms of another strategy in terms of partnering with yourself and spouse under what we call the New Deal ownership arrangement. And what that is in summary is that you can, as long as neither yourself, your spouse, or any other disqualified person has any existing or previous ownership interest in that property, you can actually partner with your IRA to purchase that property. However, once that transaction closes, you're now considered disqualified from your IRA and vice versa. In the event that you need to sell that property, or it cannot be any buyout between the disqualified person and the IRA. That property has to be sold, and the percentage of ownership is going to be determined by what each party contributed towards the purchase or acquisition of the property. So if it's 60-40, 60% towards the IRA, 40% to the individual, all income and expenses must be split in accordance to that percentage of ownership. So that's how you're going to actually take care of any expenses and take any profits. So you'd actually have to sell that property in order to get out of that contract, because you couldn't buy each other out if the parties involved that acquired the property are now disqualified from each other. IRAs in individual case or one case, plans can grow tax-deferred or tax-deferred or tax-free. In our solo K or 1Ks, you have what's called a Roth option. For those who are self-employed or 1099, you have the option to contribute up to $16,500 into a Roth for the tax year of 2012 and up to $17,500 for 2013 into that Roth 401k. So you have the option to do tax-deferred or tax-free in the 401k if you're 1099 or self-employed. You can convert tax-deferred funds to a Roth IRA using your existing tax-deferred accounts, such as an IRA or 401k. You can do either partial or full conversions. You definitely want to consult with your tax professional to determine which is the best route for you, because keep in mind, even though you may have enough money to take care of the taxes, keep in mind that additional amount that you're going to convert over to that Roth account is going to be counted as income. So it could kick you into a higher tax bracket depending on where you are currently in your tax bracket as to where you may be after the conversion. So definitely you want to consult with your tax professional before making that move. So I can't emphasize more. Be sure to establish and fund your account prior to entering into any contract to avoid any type of prohibited transaction by use of commingling of funds. So that is my presentation. I'm going to pretty much see if Seewing has any questions, but if that's pretty much it, my contact information is as follows. If you have any questions, feel free to contact me via phone or email. I also post a lot of information and content on Twitter, Facebook, and LinkedIn, so anything relative to investing, whether it be investing, real estate investing, anything relative self-directed IRA, I usually try to keep my followers abreast of that information to kind of keep them ahead of the game, so to speak, and make sure they understand their options. So that is my presentation. I'd like to thank everyone for listening in. If you have any questions, feel free to call or email me. Thank you.
Thank you very much, Lamar. This is Seewing Yee, and we are done pretty much for 1 hour. Very powerful information. I know some of you are overwhelmed with this information, but don't worry. All you, as an investor, all you need to understand is from a high level. You just if a self-directed IRA is part of your wealth building strategy, and if you have some property that you wish to purchase, hopefully through me with my organization, the Year Real Network, we have 8 market that I'm promoting, single-family homes and other investment properties, and Lamar is part of my dream team of financial advisors, and he's very proactive. He provides outstanding service to my clientele, and I'm really happy to have him come aboard, and we can do a lot of business together. And basically, I mean, if you have any, I know some of you have a lot of questions, but we are running out of time. You have Lamar's contact information. Feel free to email him or call him about any questions you have. You could also email or contact me as well. I'm always, again, very proactive in helping my clients. So this is a very powerful strategy, needless to say, and looking forward to working with all of you. And Lamar will be, again, part of my team. Thank you so much for dedicating your time to educate my investment network. And so with that in mind, thank you for everyone coming on board, and looking forward to working with everyone of my member. And thank you so much, and have a nice day. And thank you, Lamar, once again. And talk to you guys soon. All right? Okay.
Thanks a lot. Goodbye.
Okay. Bye bye.